gold is at a new record high. And while people were dumping shares of Newmont Mining this morning and Barrick Gold and Kinross and all these stocks, gold prices were going up. Even though gold initially was down $20, it rallied to $35 from there. Why? Who was buying? Well, who do you think, right? The same guys that were at the BRIC conference, because again, they're not buying the mining stocks. They're buying actual gold. That's what they need. They're not making an investment. They are replacing US dollars with a superior monetary instrument that they can hold in reserve. And in fact, a lot of these countries, China in particular, are encouraging their citizens to go out and buy gold, buy silver, right? Our government doesn't encourage anybody to do that. We try to prevent you from doing that. So this is going to continue.
Gold has entered a new price paradigm, with prices expected to remain above $2,700 per ounce, underpinned by a mix of favorable factors. The precious metal's haven appeal has been bolstered by geopolitical tensions, economic uncertainties, and heightened fiscal deficits. Combined with a global trend toward monetary easing, these elements have stirred speculative demand for gold, creating conditions that appear likely to sustain its elevated prices. In a recent commentary, American economist Peter Schiff noted that the emphasis on dollar-related risks, such as political sanctions and restrictions, during the latest BRICS meetings has likely added to gold's recent price surge. Schiff suggests that this trend of moving away from the dollar could alleviate these risks, explaining why countries like China and Russia have significantly increased their gold holdings. Indeed, while shares of gold mining companies have seen some selling, the underlying demand for physical gold has surged. During a recent interview, Jim O'Neill, former chief economist at Goldman Sachs and the originator of the term BRICS, also touched on this evolving landscape. O'Neill highlighted discussions at the 16th BRICS summit in Kazan, where talks on a potential common currency and efforts to reduce dependence on the dollar were focal points. Such shifts hint at a broader recalibration of global currency reliance. Near-term uncertainties, including the upcoming U.S. elections and ongoing geopolitical issues, are expected to sustain gold's rally into 2025. HSBC commodity analysts concur that while gold prices are poised to continue rising, the rally could face resistance if the U.S. dollar and Treasury yields remain firm. Despite these bullish trends, a combination of factors in both physical and financial markets may temper gold's rise in the longer term. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop.
China and Russia want to do business together, or companies, right? The idea is for the buys or sells to either be in RMB or rupee, right? Not in US dollars. Now, because why? I mean, first of all, it makes no sense. Why should two countries that don't use dollars transact in the dollar? Just pick one of the currencies that's involved, right? You got two countries that have currencies. Why involve the United States, a third party who's not even involved in the transaction? Why use our dollars? Use the currencies that you're actually transacting in. And so that is the goal, right? For the BRIC nations to just phase out the use of the US dollar and use their own currencies. Now, maybe one day they will come up with a new currency. I think they should just use gold. I mean, to me, it makes the most sense for international trade to be conducted in gold. That's fair. That's arbitrary. You're not just picking some other, currency, because everybody uses gold. Gold is valuable everywhere, right? Everybody knows the value of gold. Gold is used in every country. And so you could use that. You don't have to reinvent the wheel and come up with a new currency. You got money. Just transact in real money. That's already there, right? You don't have to create it. You don't have to invent it. It exists. It's been here for thousands of years, right? That's what that they should use. And in fact, if these countries decided to go back on a gold standard where their currencies were all pegged to gold at a specific rate, and they kept that, then there wouldn't even be any foreign exchange risk. If the ruble is tied to gold and the rupee is tied to gold, or the zloty or the South African rand, if they're all fixed to gold, then their exchange rates aren't going to fluctuate. And so it would make it very easy to trade. Now, of course, if a government, somehow became reckless and irresponsible, and ultimately they might have to devalue. But if once you get back on a gold standard, you're much more likely to act fiscally responsible, so you don't have to devalue, so you can maintain the relationship that you've established. But in the meantime, what's going to happen is that the dollar is going to be reduced in the transactions. That's the goal. They want to move away from the dollar. And of course, if they're moving away from the dollar in transactions, well, they're also moving away from the dollar as a reserve asset, right? If you're not going to use the dollar as much, if you already recognize the vulnerability, they talked about at the BRIC conference, the political risk and the sanctions and all that, and that's another reason for them to step away from the dollar. So this is going to happen, and it is not an accident, again, that gold is at a new record high. And while people were dumping shares of Newmont Mining this morning and Barrick Gold and Kinross and all these stocks, gold prices were going up. Right? Even though gold initially was down $20, it rallied, $35 from there. Why? Who was buying? Well, who do you think? Right? The same guys that were at the BRIC conference, because again, they're not buying the mining stocks. They're buying actual gold. That's what they need. They're not making an investment. They are replacing US dollars with a superior monetary instrument that they can hold in reserve. And in fact, a lot of these countries, China in particular, are encouraging their citizens to go out and buy gold, buy silver, right? Our government doesn't encourage anybody to do that. We try to prevent you from doing that. So this is going to continue.
The US dollar rose to a fresh 2.5-month high on Tuesday, maintaining its upward momentum as investors brace for a potentially tight presidential election. Expectations that the Federal Reserve will take a more cautious approach toward interest rate cuts have bolstered the greenback, attracting investor interest as Treasury yields rise. The dollar has gained for 3 consecutive weeks, with positive U.S. economic data further reducing the likelihood of aggressive rate cuts, thus strengthening the currency. Financial commentator Peter Schiff recognizes the consensus that the dollar may decline long-term, but is skeptical about its current rally. While some suggest that demand from those with significant dollar-denominated debt might temporarily boost its value, Schiff points to past instances, like 2001 to 2008, when high dollar debt did not stop substantial declines in the dollar's value. This suggests that strong demand may not prevent a downward trend. As Election Day approaches, the dollar's rally remains a focal point for investors weighing the impact of fiscal policies, Fed actions, and global debt dynamics. While debates around the greenback's trajectory continue, the currency's current strength reflects a complex blend of economic expectations, policy forecasts, and global financial pressures.
And that is the dollar, because there are people out there. Some of these people are going to be at the New Orleans conference. George Gammon, Brent Johnson, they'll be there at this New Orleans conference. But they're on the opposite side of me, at least in the short run, when it comes to the dollar, right? I mean, I'm out there saying the dollar is going to crash, and they're saying, no, the dollar is going to surge. The dollar is going way up, and then it's going to crash. So they kind of agree with me that eventually the dollar crashes, but they just think it's going to have a huge rally before it does. And I think it's already had a huge rally. I don't know that rally is going to get any bigger. I mean, we have had a big rally in the dollar since the lows of 2008. The dollar index was down around 71, and now it's 104, and it did get higher than that, but that is a rally. Now, obviously, they think, well, the rally could be much bigger. And their thesis seems to boil down to the fact that there's so much dollar debt. And because so many countries have to repay dollar debt, that there's going to be this demand for dollars because I owe dollars, so I need dollars to pay my debt. And the fact that these companies around the world that owe dollars, need dollars, is going to put all this upward pressure on the price of the dollar. And maybe if you just look at it superficially, yeah, okay, yeah, all these countries, companies have borrowed dollars, they have to pay back their debt. And and then if they default on their debt, the people who were owed those dollars aren't going to get them, right? So dollars are going to disappear because companies are going to go broke because they can't afford to repay their dollar debt. And so all this is supposedly going to be bullish for the dollar. And I don't buy into that. First of all, that was true. Companies had a lot of dollar debt from 2001 to 2008 when the dollar index went from 120 down to 70. I mean, that was one of the worst bear markets that we've seen in the dollar. That was an all-time record low for the dollar index. I remember the dollar got down, to just 80 Japanese yen. It's, doubled since then, although it's pulled back from that high. But so the dollar was able to fall in that environment. And, the world still had a lot of dollar debt back then. In fact, the dollar was a bigger part of the global economy, as far as a percentage of reserves or trade than it is now. So it still happened. But what I think the people that are missing is that just because I owe dollars, I owe dollars to another foreign entity. So let's say, you're a Polish company that owes a German company dollars, right? You just did a deal in dollars, right? You didn't do it in zloty, you didn't do it in euros, you did it in dollars. So there's dollar debt on the books of this company. Well, when the Polish company repays its dollar debt, what is the German company going to do with the dollars? Well, it's going to sell the dollars to get euros so it can pay its expenses, pay workers, rent, dividends, whatever. So just because a debt is owed in dollars doesn't mean it's staying in dollars. So yes, there's demand for dollars to repay dollar loans, but then when people get repaid those loans, they sell those dollars, right? It's not like they're just going to hoard them, especially if the dollar is going down, right? If the dollar is falling and somebody is repaying you dollars, you might want to get rid of them as quickly as you can.
With nations diversifying reserves away from the dollar and toward physical assets like gold, its demand dynamics reflect broader market adjustments that could sustain elevated prices. However, the US dollar's recent strength, driven by rising treasury yields and cautious Fed policies, signals potential headwinds in the near term. While these factors create a complex market environment, understanding the balance between global currency shifts and investor sentiment will be crucial for those navigating these evolving trends. How do you see the future trajectory of gold prices and the evolving role of the US dollar on the global stage? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.